I made this masterclass to show you how to outsmart the market using a few psychological techniques. Investor performance is 20% finance and 80% psychology. So I'll be covering powerful strategies and tactics used by the CIA and Goldman Sachs in this video. I respect your time, so let's jump right into it. The illusion of knowledge. That is the first thing that we need to talk about. You don't know what you don't know. Okay, if you want your performance to be a lot higher, you need to start being aware of everything in the stock market, what's driving the stock market, what's driving your positions in the stocks and options. And in this topic, I want to introduce you the concept that many traders, they believe they understand options, but in reality, they're missing some critical insights, like avoiding assignment with strategic rollouts. Instead of letting your options get assigned, roll your positions before expiration by buying back the current option and selling a new one further out in time. This helps you keep control of the trade and avoid stock ownership or forced selling. So many people don't realize that you can fix an option by simply rolling that option. I'll be showing you an example later on in this video, but that is the first thing that a lot of people are not aware of. Now, the second thing, and this is really crucial, use delta as a risk gauge. Monitor the delta of your option to assess the probability of it being in the money. Keeping delta low, around 30 or even 20 or even a little bit less when selling puts or covered calls can help you reduce the likelihood of assignment while maximizing income. Next is exploiting ex-dividend dates in covered calls. Okay, these are all the things that I'm talking about which most people are not aware of, but you can exploit an ex-dividend date in a covered call. Here's how. Be cautious when selling covered calls near an ex-dividend date, as your stock could be called away early if the call is in the money, costing you both the dividend and potential future gain. So that is really something that I do pay attention to. I personally don't trade a lot of dividend paying stocks, but if you do, if you're running my double dividend strategy, which I have a video on this channel, then you want to be aware of when the ex-dividend date is, because that is an attractive time for investors to actually want to exercise. When I do my one-on-one coaching, and my students ask me, hey, should I be afraid of, basically potential assignment? I always pretty much say no. Early assignment almost never happens. The reason why it doesn't happen is if you take a look at an option, a lot of its value is based on time. And when you exercise an option, you lose that time value. So most investors don't do that because they lose a whole lot of money by exercising options early. Next is tracking implied volatility rank. Okay, this is really interesting because I've talked about implied volatility on this channel. I'm always bringing you guys new content, so make sure that you are subscribed. I want to talk about implied volatility rank, or IVR, for better entries. If you want to actually get into a stock and get paid properly by selling options, you do want to pay attention to implied volatility rank. And look, use implied volatility rank of a stock to basically time your entries. Now, I'm not a fan of timing the market, but if you want a better time or you want to try to time the market, looking at implied volatility rank is really important. And it actually makes a lot of sense. So think about it this way. So let's say that a stock is typically, on average, it's going to be 50 IVR, right? Because that's like average, right? 50 means that it's average. Now, if you look at the IVR and it says 80, right, 80%, that means that this stock is towards the high end of its implied volatility. This is a little bit unusual, okay? Something unusual is typically a good thing to pay attention to, because if it's unusually high, that also means that the premium is also unusually high. So that's a good opportunity for you to sell an option. So for me, I don't like to time the market, but I'm just selling options all the time. I'm always selling. I'm always selling my Monday and Wednesday coaching calls. I'm just selling puts. I'm selling covered calls. I'm using Nvidia. I'm using Palantir. I'm using Apple. I'm using any high quality company just to sell options and collect that income. You probably watched a lot of my videos already. When I'm selling options, my goal is to enter in a stock at a better price, or if I already have a stock, to create income on the stock that I already have, right? So when I'm looking at entry IVR, when it's higher, means that premium's higher and I'm going to get paid more when I'm selling options. So it's a good way to kind of time the market, if you will. Although I think timing the market can be the most difficult thing ever, I think that there is some opportunities to get better entry, and better entry is what it's all about. Putting the odds in your favor, making probability work for you, and having a better entry will make a very big difference in your overall trading performance. It's important to be aware of your psychological blind spots or gaps in knowledge, because that's where most risk lies in your wealth building journey. What you don't know is what you don't know. and there's a lot of risks there. So I'm trying to fill in your entire gap, and that was the first lesson. Now, I wanna go over our second lesson, our second psychological bias, okay? I study a lot of psychology because the market is a tremendous amount of psychology. So it's really important, no matter how boring you think psychology is, it is extremely important to your profitability. So our second lesson in this course is going to be overconfidence bias. All right, our first lesson was you don't know what you don't know, and I mentioned you a lot of things that you may not know. Now, our second lesson or chapter here in this course is going to be overconfidence bias, which is really interesting, and I'll explain to you what this looks like. So first of all, I'll give you a shocking example of overconfidence bias, and that's that when they have surveyed drivers, okay, 80% of drivers believe they are better than the average driver. Doesn't really make sense. 80% of drivers believe they're above average, but by definition, average means that it's 50%. So that means you'd be better than half, and then you'd be worse than half. But 80% of drivers said that they're better. So that explains to you that overconfidence is most people think that they're much better than they actually are. And I don't mean to hit any egos here, but we all have an ego, but you're probably not as good as you think you are because we all have blind spots and we all have room to improve, right? That's what I always think. I've been doing this for a decade now, and I have one portfolio that I've grown to 3.5 million. I have a second portfolio that's also around that same value that I've both grown over a long period of time. And I'm still, luckily, I don't know why this is, but I've just been really humbled. I did a lot of martial arts or maybe whatever. I don't get overconfident in my portfolio. I am just as good as my last trade. That's what I always tell myself, okay? Same thing with Amazon CEO, right? Jeff Bezos basically said he expects Amazon to one day go bankrupt. He expects there to be competitors. He expects that Amazon may come into issues down the road and they must function as day one of the company, okay? Guys, I want you to have the same mindset, all right? Because this course, my chapters will teach you things that will help you trade. And it's most important for you to have a good mindset. That's like basically having good hygiene or good health, right? It doesn't matter if you're the smartest person in the world. If you don't take care of your health, it's useless, all right? Same thing with psychology. If you don't take care of your psychology, you are going to get yourself in a big pit when it comes to investing, because I've seen it over and over again. I've seen students that are like, I'm doing great. I just talked to a guy yesterday. I made $11,000 the past 2 months on my $150,000 portfolio. Fantastic. I asked him, how long you been trading for? He said, 2 months. That's my first 2 months. I said, beautiful. That's amazing. How did you do that? He's like, I've been just watching your videos. Fantastic. But obviously, it's been 2 months. The guy is having good performance, but he definitely has a lot of blind spots, right? He definitely has overconfidence bias. I said we should coach together. He said, no, I'm going to keep doing it myself. No problem. We're going to see what happens there. But I just want to say that the more you know and the more you're aware of potential mistakes that you can make and not getting overly cocky, the better, right? I'm not saying something bad is going to happen. I don't know, right? But I do see that overconfidence bias affects people very negatively. They have many good months and then boom, they have one bad month, and it's not that hard to blow up an account. It also doesn't look as bad, but it's actually bad. I see people that have a 45% return in 6 months, and they're very confident, like, oh, I'm going to do fantastic. They have 1 month that's losing, which is -8%, which isn't even that big of a loss, right? -8%. The next month they have -2%, right? And then the next month is, let's say, 0%, and they start getting revenge trading, okay? I have a student that I actually will put on this channel that I talk to in my Wheel course, which is coming out very soon. Make sure you're subscribed for that. I have the best courses coming out for free on YouTube. It's freaking insane. I'm just putting everything I have here because I'm super motivated to help you guys learn. I love what I do, and I just want to be the #1 coach here and give you better free information than people charge for, all right? Because I see a lot of option YouTubers, and a lot of them have learned from me, first of all, a majority of them. And the second thing is, I wanna make my free content better than people's paid content. That's something that I've learned from one of my mentors. So giving you everything for free just to help you scale up, make money, and then maybe you'll wanna do some coaching with me, which is always the first link in my description. But if I make you money for free, it's completely up to you, right? I just love what I do. So look, what I was trying to get at there is that if you have a 45% return, and then it's -8, then it's -6, and then it's -2, your overall 1 year return can actually be 20%. That's crazy. You could start off with a 45% return in the first half, and because your second half is bad, you end up with a 20% return. It is not a sprint, guys. It is not a sprint. This game of investing is a long-term game. That's why I don't get emotional when it comes to investing. It's because I've been doing it for 10 years. I see the market fall. I'm like, oh well. I see the market going up. I'm like, oh well. All right. There's a story of, based on psychology, and I think this is really important. I'm going to give you a little bit of a story here. All right, so here's the story. Again, I'm making this video a little bit longer because I want you to understand psychology on a very deep level. So if you have the attention span for this, by the way, congratulations, because you're going to be a better trader. People that don't have an attention span, they're bad at trading. So congratulations for being in this part of the video. So look, here's the Chinese story. All right, so once upon a time, there was a Chinese farmer whose horse ran away. And that evening, all his neighbors came around to basically say, "We're so sorry to hear that your horse ran away. This is the most unfortunate." The farmer said, "Maybe." The next day, the horse came back bringing in 7 wild horses with it, right? And in the evening, everybody was like, "Your horse came back and it brought 7 other horses, man. Congratulations, now you have 8 horses." The farmer said, again, "Maybe." The following day, his son tried to break one of the horses, and while riding it, he was thrown and broke his leg, okay? And the neighbors were like, "Oh, that's such bad news. That's so unfortunate." And the neighbor said, "Maybe." The next day, the officers came around to script people for the army to go to war, all right? And his son had a broken leg. So again, all the neighbors were around saying, "Wow, you got so lucky. Holy moly, your son doesn't get to go to the army to fight and potentially die," right? And you guys can guess, the story's almost over. The guy says, "Maybe," right? So the whole process of nature is an integrated process of immense complexity, and it's really impossible to tell whether anything that happens in it is good or bad, because you never know what will be the next consequence or the misfortune, all right? You never know what will be the consequences of good fortune either. So that is I guess this is a quote from Alan Watts, right? So that story kind of paints you the picture that it's maybe. Every trade is a maybe. Don't ever get hard on yourself. If a trade doesn't go your way, it's okay. Make sure that you're playing the long game. It is the long game, right? The guy broke his leg. They said, "Oh, that's such bad news." Well, he said, "Well, maybe." And the next day they came to draft the army, and it was good news, right? So bad news can be good news can be bad news, all right? This also goes back to chapter 1, what I said, which is you don't know what you don't know. So good news doesn't mean it's good, and bad news doesn't mean it's bad, all right? It's all how we think about things, all right? And when it comes to trading, that is really, really important. That story will paint you the picture that you want to keep that long-term mindset, okay? And in the second chapter here that we're still in is the overconfidence bias. So let's continue and wrap up with the overconfidence bias. So similarly in trading, most people think that they can consistently outperform the market, but studies show that over 90%, so I said over 80% of drivers think they're good. Traders are even bad than drivers. Traders are even more cocky than the drivers, okay? So 90% of traders, of active traders, underperform the S&P 500, yet 90% of people think that they can beat the market. Guys, 90%, are you kidding me? 90% of active traders can't win. It's good that I teach option selling and collecting income with the wheel strategy mainly on this channel, because most people win with the wheel strategy. In fact, in my community, we have over 80% of people that join end up winning or being successful in some way, whether it's $1,000, $3,000, or $5,000 a month. Whatever their goals are, they are profitable about 80% of the time from the data that I have researched. So I teach option selling and collecting income with the wheel strategy, because even if you are overconfident, the wheel strategy is so safe that it's actually hard to lose money, as you guys will see in the wheel strategy course that I make. I'm still editing it. You will see how you can be overconfident and still not lose money in the wheel, which is fantastic. I like to put people in winning positions, and that's overall a win. So overconfidence can be extremely dangerous, especially if you're making money and then you start buying options. Okay, I've seen that happen. I've also seen people just increase their deltas and chase higher and higher premium. And then all of a sudden you see them selling at the money puts on GameStop, or at the money puts on Rivian, or at the money puts on high, really, really risky stock. So I see that happen all the time. So make sure that you're aware, guys. If you're aware, all right, and I'm a man of faith. For me, it's important to understand who I am, what I'm doing for other people. It's important for me to have a good connection with God. That is very important for me. And whether you're religious or not, I want you to understand that being more in tune with yourself and understanding yourself actually makes you better in all areas of your life. It makes you better at relationships. It makes you better with other human beings. It makes you a better person overall, but it also increases your results, okay? I'm a firm believer, right? I wasn't always like the most religious guy, but as time goes on, I'm building a relationship with God. I'm building a relationship because I've achieved everything I could possibly hope for, and now I'm giving it back to you, and I'm thinking, how did I do this? Well, maybe some of it is luck, maybe some of it's hard work, but I really think that I've actually been doing the right thing in life, which is why I've gotten success. So I want you to have that same mindset, which is, always be humble. Be humble. It doesn't matter how much money you have. I have a ton of money. I have more money than I show on this channel. I have enough money to do a lot of things with, right? But I'm not getting overly cocky. I'm still showing up here on this YouTube channel, even though I don't need money. I'm still showing up. Yes, I have a business. I'm a coach. I have a big team that I want them to do really good. They have families to feed, so I do charge for my coaching, and I have an exclusive luxury coaching. I work one-on-one with folks. But it doesn't stop me from understanding who I am, being humble, and not getting overconfident. That's very important on a personal level, person-to-person level, on a trading level, on a driving level. Don't get cocky on the streets, guys. You're getting cocky while you're driving, not a good idea. I do have a sports car right now that I'm renting in Poland. I'm living in Poland. I'm living in Eastern Europe. I don't get cocky, because other people could be bad drivers. I can get into an accident even though I know how to drive, someone else might not. So you always need to keep your eyes on the road. Don't get cocky in any area of your life, okay? Luckily, I don't get cocky in any area. So it's really important. And also, a study published in the Journal of Finance found that overconfident traders are 60% more likely to trade options excessively, believing that they can predict short-term market momentum or movement, all right? That's also something, right? So again, there is a lot of proof out there that people's egos get to the better of them. And I see that across the board. I would say, yeah, like 90% of traders fail. 90% of people have a bigger ego. So it's fine. Egos can be healthy, but you need to understand when you're revenge trading. You need to understand when you're excessively trading. You need to understand even in good times, you have to prepare for the tougher times that can potentially come, right? We're going into an election year, right? Maybe as you're watching this video, the election already happened. Maybe we're in 2025, right? But still, there's always catalysts and events in the market where being overconfident will hurt you. Even when the market is really bullish, you can always have a bearish move. Even when earnings are good on a stock, right? You see it all the time. You see earnings that are good, the stock can still go down. So it is always humbling, actually, when I predict the stock to have good earnings and has good earnings and it still goes down, I say, it's a good thing you had proper risk management. It's good that you had proper asset allocation. I remind myself that I'm humble going into the trade because I have diversification. I knew that the stock would beat earnings, but the market didn't agree with me. The market can still go down. So I could be a genius and predict everything, and I could still be wrong because this is a very humbling game. Also, I just want to say that when you're excessively trading, even if you're right, excessively trading in general is also bad behavior because this behavior often leads to higher transaction costs and on average, lower returns compared to more cautious traders who limit their volume of trades. That's why in my community, I'm just following literally 15 to 20 stocks and I just run the wheel, sell puts, covered calls. I do some spreads as well. For sure, it's easier for me to focus on folks that have $50,000, $100,000 portfolios or more. It's just easier to scale. So I do prefer working with folks that have at least, $25,000 to trade would be kind of like the bare minimum. So if that is you, by the way, if you're a busy professional that has $50,000 and you want to scale up your income and get to 5 figures, or you have 6 figures, you want to get to 7 figures, again, I do coach one-on-one on that. So look, I just want to wrap up this topic before we go into the next chapter. I want you to be aware that even if you're trading for many years, there are still events, indicators, setups, and trends you may not be familiar with, and it's important to always be learning and improving. Speaking of improving, before we get into the second or the third psychological trading secret in this chapter, I want you to level up your premium that you collect and scale. All right, the next psychological chapter that I want to discuss is the false safety of limited risk options, okay? Many traders are drawn to strategies like buying calls or puts because they appear to offer limited risk. This is actually a big fake myth in the industry of option trading, okay? There's a lot of people offering option trading advice nowadays. More people are jumping into it, okay, to be teachers and provide the information. But literally all of them, I wouldn't trust for the most part, okay? Because a lot of them didn't really work in the industry. It's really important to understand where you get your information from. If you get your information even from a millionaire on the internet, but they don't have the actual experience of working on Wall Street, of actually having a degree in it, I'm not a big fan of formal education, but when it comes to trading and investing, I am in favor of formal education. You don't have to go to college to get rich nowadays, but I did go to college for finance, and I'll tell you what. I work with a lot of engineers, and it's very similar. There is a difference between self-taught engineers and actual computer science graduates. There is a difference. They will make you, the industry, and there's a lot of psychological tactics that industry and in politics and anything where money is involved, there's a lot of psychology going on there, right? You will see that when it comes to, for example, getting a job in software engineering, which is a large amount of my students, right? Doctors, lawyers, professionals, engineers are huge, like 90% of my audience for who I work with, because they have the money, the high income, which obviously helps with option trading. You can do it option trading if you're not one of those professions, but that's the majority. So look, if you're self-taught, cool, you can be really good, but the computer science major understands algorithms, data structures. They understand a lot more deeper level of programming, whereas someone who is self-taught may have missed some of those fundamental components. And when you do look at the best people in IT, in innovation, in entrepreneurship, right? When you look at Sam Altman of ChatGPT, when you look at, Microsoft, Bill Gates. Yes, Bill Gates didn't, he dropped out of college. Mark Zuckerberg, right? But they did go and they did take their fundamentals of architecture and data structures, etc., formal education. They do have some form, okay? Whereas with your self-taught, you're not going to be as good as someone who has a deeper understanding. So I just wanted to point that out from both of a provider of teaching you guys perspective, but also from your own perspective of trading, okay? Both. I'm giving you lessons on multiple different levels right now, okay? If you want to actually be good at trading, study this stuff, okay? Understand how it actually works, because a lot of the marketing in the industry, right, of option trading will tell you that, hey, there is limited risk when buying options. That is true, but it's kind of a lie as well, because the limited risk is false limited risk. I'll explain that to you in a second. I also want to point out that by this psychological course, I hope that you're understanding in the first 2 chapters, selling options, which is my agenda, what I'm teaching, is also not always best. There's also a lot of people that say, oh, just sell options. You're going to make income, right? I have $1 million. Here's my strategy for selling options, right? Whatever. That can also be false, because you can also get into trouble selling options, although it's much harder, because selling options in general is very profitable. So let me explain to you both sides, okay? Why it could be a psychological myth that it's limited risk to buy options, and why selling options can also be either risky or lower return, okay? So let me go over the first one. Let me talk about the framing. This framing is often emphasized in media by brokers or YouTubers. Usually they don't have as big of an audience. They're more niche, right? So they're teaching something more niche to build a following on that specific mindset or structure, right? So they portray options as being safe, right? And they say, oh, it's safe. You can buy options, put up a limited amount of money. Not really. Because when you put up a limited amount of money and you lose 100% of that money, sure, you're limited, which sounds good, but 100% loss doesn't make any sense. The same thing with option selling. If you're not doing it properly and you don't have a good entry and you're doing the wrong stocks and you're just doing hype stocks, you're also going to get messed up, because it doesn't matter what strategy you're using if you're selling options on bad or the wrong stocks. And before I give you this example, I just want to point out one more thing. What gets less attention is that in reality, most options expire worthless, leading to frequent small losses, okay? That's what I said. Most options, even when they have a high delta, which means that it's likely to be okay and it's likely to be in the money if you're buying an option, still many options expire worthless, okay? That's why I do prefer being on the selling side in general than the buying side. So now I do refer to buying options as gambling or buying lottery tickets in some of my videos, especially when I cover more risky strategies. I have a video that talked about butterflies, and I have a video that talks about iron strangles, like interesting stuff, right? Definitely interesting, where you can turn a little bit of money into a lot of money. However, I prefer to focus on people that want consistent income. And I do refer to those strategies as high income and high potential, but also straight up, I look at them as really in that gambler's category, all right? Although gambling, by the way, can be profitable, it's typically like a poker table, okay? Where there's one huge winner. Typically there's 9 players, right? I watch the World Series of poker, and that's actually one of my goals, is to go to Las Vegas and play around November and play the poker. There's a lot of famous celebrities, but look, there's one huge winner. There's one guy that breaks even, and there's 7 losers. So it's really a winner takes all type of game, all right, when it comes to poker in many ways. I mean, you could have a game where it's a little bit more evenly dispersed, but there's something called the Gini Index. Gini Index is the disparity between rich and poor in countries. And that applies for a lot of things in life, right? So in poker, there's one winner, there's many huge losers all over the world, in China, in India, Pakistan, and Russia, and Turkey, South America, in America, it doesn't matter. All the countries, there's Gini Index. People don't get paid the same. The rich get richer. And I took a class on wealth and power back in college. The rich get richer, okay? The poor get poorer, and the disparity grows. And that's why the middle class is in danger. And the middle class is in danger because inflation is going up, middle class continues to make money and they're not keeping up with inflation. So technically the middle class is kind of shrinking and kind of going into that bottom poorer, lower middle income or lower income class. Whereas the rich class, which I'm new rich, right? I didn't grow up with money, but I would say I am high net worth. It is much easier to make money because once you have money, one of the strongest factors in making more money, but the ways to get rich is labor, capital. Right now, AI is a big way to get rich. AI for sure is the number one way to get rich right now. I'm blanking on the fourth way, but once you have money, using capital to get more money is extremely easy. So the rich continue to grow their wealth very quickly. It's extremely easy. And then the middle class continues to struggle. So you have to try to get more capital and really scale to be in the richer class. Because if you're in the middle, it's not looking good for you. It's not looking good for you. I can't tell you how many engineers I talk to that are making 200K, 220K, but they hate their job, first of all. And second of all, they're afraid that AI will replace their job, because even if you work at Meta, even if you work at Adobe, wherever you work, even if it's a good company, you still have a chance of getting fired, right? Unless you own a business or you're an entrepreneur, which is also risky in different ways, you're not safe. Even if you're a subject matter expert at a company, that company could say, hey, we're cutting costs. Sorry, we're gonna have to, you're done, you're out of here, right? So that could happen at any day. So it's really important to get to that scale or to get to that six-figure mark in your portfolio, so then you can get that six-figure portfolio into multiple six figures, and that multiple six figures to seven, and then it's really easy. Once you have seven figures, you're good. I mean, you're retired, it just depends on how well you're retired, right? So look, what gets less attention is the reality that options expire worthless, leading to frequent losses. I refer to buying options as gambling. I also want to point out that in the poker example, the Gini index, which is what we're talking about and where I'm giving you stories, is prevalent in all forms of life, right? Whether it's the middle class and the rich class. It's also very apparent in dating. So by the way, I mentioned dating because I have a huge interest in data, guys. I have a data analytics degree, finance, economics, data analytics degree. And I look at Tinder because Tinder has vast amounts of data, okay? All the S&P 500 companies, and Tinder is owned by Match.com or Match Group, right? I specifically look at Tinder because, first of all, I do use it. I have used Tinder. I do date in Eastern Europe. But the other thing is, I like data, guys. Data is how I make my decisions, okay? I make data-driven decisions. When it comes to psychology, there's many easy ways to lie about data. There's a lot of misinformation online, even from your option gurus that seem to have money and to seem to have a good brand. There's a lot of misinformation out there, okay? So when it comes to misinformation, I like to use data to decide, okay? And I have a data analytics degree, and I love using vast amounts of data, guys. One data point isn't enough. One data point is not enough, okay? You need a lot of data. So looking at Tinder has tens and hundreds of thousands of data points, right? And I looked at a lot of studies on Tinder. Some of them are public and some of them are taught by the CEO, the chief marketing officer, etc. on these calls. They'll go out and say, hey, these are our data points. This is what we're looking at, right? Because as a company, Tinder is trying to decide how to keep people on the platform so more people are paying Tinder and staying on the platform, right? When they looked at the data of men and women, it seems that men will swipe left and right. So if you don't know how Tinder works, it's men and women both on the platform, and they're both looking to, if you swipe left, that means you don't like someone. If you swipe right, that means you like someone. If you swipe right and they swipe right, you have a match, and then from there you get to have a conversation, right? So when they look at the data points, right, women, they find something a little bit wrong, they swipe left. They swipe left immediately because women are the choose your sex, because obviously there's biological repercussions, whatever, right? I'm not going to get into all the biology of things, but they have a higher reproduction cost, right? Because women, when they have a baby, it is higher cost than a man who could, in theory, have hundreds of offspring, whereas women cannot, right? So on Tinder, this is actually a fact. It actually shows you through data that women will swipe left. They don't want 90% of men. They don't want them because they don't meet their standard, they don't meet the looks, whatever, something has turned them off. Men, on the other hand, swipe 50-50. Or even more, leaning towards yes on most women, because men are much less picky than women, and this is through data. And this is a very interesting phenomenon that actually has a lot to do with trading, because trading is statistics. Statistics and data help you make better decisions. And the game of trading is all about risk. While it may seem low risk because the loss per trade is capped at a certain mark where you're buying options, These consistent small losses can slowly erode an account. So small losses can lead to huge losses, especially if you're chasing short-term price movements. And the idea of limited risk in this case is misleading because the likelihood of winning big is much lower than it actually appears. Just the same way as I mentioned with poker, the same way that I mentioned with the Gini index, where rich people getting richer and poor people getting poorer. There is statistical facts that you can take advantage of, and the same thing applies for the market. That's exactly what I do with my option selling. Every morning I do a lot of research. I'm trying to exploit statistical anomalies, okay? So when you're selling options, for example, I'm looking for statistical anomalies. Now, I don't necessarily have as much data as I used to. So I used to work on Wall Street and I had access to a lot of data. Part of the reason I have a data analytics degree is because stock market is just a lot of data information, right? And I was working at a hedge fund, and essentially we were trying to predict if a stock was going to beat earnings or not, okay? And if they beat earnings, obviously it has a chance to win. So I had many different factors that I've worked on. It's called factor analysis. Stuff I don't talk about on this channel typically because I try to get really to the point and I try to keep it more like broad because I have a bigger audience, right? I'm the #1 option coach in the world and I have a lot of views. So I want to keep it very high level and then I make it a lot more like specific in my Discord community, right? But in this video, it's a longer video and I want to give you all the knowledge that I know. I hope you're really enjoying these examples because straight up what I'm talking about, no one talks about because they're not as they don't have formal education. They don't know how to talk about it. Like I have a data analytics degree, so I can talk about statistics and data analysis and give you real examples because I have a lot of experience here. I worked at hedge funds more so as a financial analyst and a quant, and I wasn't a trader, guys. I don't have licensing to be a trader, but I'm, in my opinion, better than a trader because I actually know how it works on a deep level and I use statistics to outperform the market. Really important. If you look at Jim Simmons or any other hedge fund titan, a lot of them are mathematicians. They are mathematicians and they're exploiting the market through algorithmic trading. So I did not do algorithmic trading per se, but I was looking at multi-factor models, which can be applied to algorithmic trading. All right, so I want to discuss, after working at Goldman Sachs, 2 hedge funds, economics, finance degree, all that stuff, I'm telling you that you need to understand statistics better, and I hope that this video has changed how you think about statistics with some of the examples I gave you. And by the way, to wrap up with the Tinder example, yeah, women are just a lot more picky when they choose a partner, whereas men are not as picky. And also one more crazy thing is the top 10% of men will match with the 80% of women. So it is, again, the Gini index. The rich get richer, and the same applies for Tinder statistics. The top 10% of men, the best looking men, the tall men. I'm not particularly tall myself. So if a man's 6'3", literally life is kind of easy, right? Life is a lot easier. It's a lot easier. When you're a tall man, your options just completely open up. All right, just completely open up because a lot of women's preferences are taller men. So on the Tinder dating app, you'll see that, and I, by the way, I talk to a lot of guys. I have a lot of friends here in Warsaw, Poland, because it is a very good place for entrepreneurs. There's a lot of entrepreneurs here because entrepreneurs are leaving America because the dating is really bad there, and they're going to other countries. There's a trend on the internet called passport bros, where basically men are going to other countries where it's much easier to find their dating preferences, right? I won't go into too much detail, but there's a lot of travel going around on the men's side, right? Going away from America. And I talked to a lot of men, and there's a clear correlation. It's not an opinion. It is a clear correlation. Being taller gets more results, just like being richer gets more results, right? Being better looking, you make more money. It's just a proven fact, and there's multiple research studies on that. So I'm not going to beat this whole Tinder example on by a dead horse, but just to wrap it up, the top percentage of men get 80% of the women, and the bottom 50% of men get 0 results, absolutely 0, right? So that's the same thing in economics. The bottom 50% of society has no wealth. They have like 1% of wealth. Like the bottom 50% of America is like debt, nothing in their bank account, 2K, 3K, they can't even afford to fix a tire, right? They can't. They have an emergency expense. 67% of Americans say that would be a problem to fix, right? They can't fix a flat tire because they don't have the finances for it. And then from 50% to 80%, this category has money that's like your middle class. They have some money. But then once you get into the top 10% of people's earnings, it like starts to skyrocket. Like for me, my income, I've taken a look at it. It probably puts me at around 0.5%, right? So half of 1%. I don't know what it is for my age. If I look at it for my age, I might be even lower. I'm a little bit on the younger side, but still, if you look at wealth, it's like this, right? And the people that are richer than me are way richer than me, right? People have 50 million, 100 million, and then Leonardo DiCaprio money, and then billionaire status, right? So there's many, many levels to the game. I'm just somewhere farther along towards that level, right? Same thing applies in all areas, including trading. What level are you at? Because there's many, many levels that you're not even aware of that I want to bring to your attention. Okay, I'm not even the best trader, guys. I am not the best trader. There's traders that are far, far better than me, but they're not on YouTube because they're busy being traders, all right? They're busy being traders, which I personally am more of a social personality, so that's why I'm on YouTube. I'm the best option coach with the best results on YouTube. There's better people than me, but they're not on YouTube. I'm actually a trader, and I became a millionaire as a trader, and then I later on became a coach. So I want to be really clear about that. So if you want to get rich, you need to understand how to put probability in your favor. The Gini Index, how do you become that one poker player that's a winner? How do you become that top level Tinder guy that gets all the matches? How do you become the top 1% trader? How do you do that? Well, it's not with limited risk options, and it's not by really even selling options. The secret is being in high probability, positive expected value places. Positive expected value. I'm going to explain to you what positive expected value means. This is statistics, and I'll explain to you what it means in just a second. Let me discuss one more thing here. I have some notes here, and I wanna stick to it. I wanna be organized. The overemphasis on the safety of buying options is a classic example of how the industry uses framing to shape perceptions on the general public so you can make more trades and spend more money with a broker. This pisses me off, guys. A lot of people, they overtrade because the industry makes money off of you. The industry makes money off of you over trading. So I'm telling you right now, trade less if you want more results. I'm making free videos. You don't have to buy anything. I don't recommend buying financial education for the most part. Okay, if you want more coaching with me, that's cool. But in general, I've looked at other programs. I have students coming from me from other programs, and they all say the same thing. The program was okay, but I didn't learn anything new. Or the program is pretty good, but I didn't get any results. It's always like the same conversation when they come to me. And they've tried all the other programs because you guys watch a lot of channels, and I see the data. I have tons of data. I actually see exactly when you guys click off the video. I see how many people subscribe, how long you watch, down to the second. Okay, it's actually crazy how powerful YouTube is, and also points out how important data is because it helps me become a better coach. And I see that in my coaching programs as well. I track students' results. I track when they're successful, what mistakes they're making, and over the years, I figured out the common mistakes and how to avoid these mistakes. I've also realized better coaching styles because I've been at it for 5 years. I'm the first option coach on YouTube for the most part. There's a guy, maybe there's a couple of people older than me that have more subscribers, but they're not coaches. They own brokerages, like literally like Tastyworks owns a brokerage, right? That's the only guys that have been option coaches longer than me. They literally own brokerages. And I look at students' outcomes, and I'm always trying to think to myself, how can I make students better? How can I make them take less mistakes? And the overemphasis on the safety of buying options in the marketplace is an example of how industry uses framing to basically make you trade more. And I always tell students right away, do not trade so much. You're just making the brokerage rich, not yourself. You want to get rich. Don't make the brokerage rich. Don't make, others rich. Make yourself rich. Make yourself rich. That's why in Discord community, when I trade live on Monday and Wednesday, I just do 10 to 15 trades. I am not doing too many trades. First of all, it's bad for your time. And second of all, it's bad for commission. And even if you think your brokerage is free like Robinhood, it's actually not free, guys. Robinhood is not free. Hello, wake up. Nothing in life is free, all right? For the most part, nothing in life is free. So Robinhood is not free. They're giving you subpar execution, right? And there's also bid-ask spread. So every time you trade, other people are trading and they're providing liquidity and volume, you're losing money. So you're probably learning a lot of stuff in this video. I'm really happy for it. If you are, please subscribe. It would mean the world to me. So look, many traders, and this is not for my ego, guys. I'm literally telling you what works. My goal is profitability and results for my students, and I put my money where my mouth is, so I don't go for false safety, and I also go for high probabilistic outcomes, which is really interesting. Look, I'm gonna tell you a story that's gonna blow your mind, all right? This story is gonna blow your mind about Warren Buffett. Warren Buffett famously, he got documented declining a bet related to golf, specifically in the context of his humility and self-awareness regarding his golfing skills with his best friend, Bill Gates. This incident occurred during a conversation with Bill Gates back in 2010, right? This is what I found online, but I heard about this story a long time ago. Buffett and Gates were discussing various topics, including their favorite pastimes, right? Gates jokingly suggested, hey, Warren Buffett, let's make a bet on golf. If you win $10,000. If you can beat me in a round of golf. Warren Buffett said, I don't know, man. So how much do I have to bet? Bill Gates said $1. Bet me $1. You bet $1. If I lose, you get $10,000. $1, you bet $10,000, you win. Wow, guys, that seems like a really good, profitable bet, huh? That seems really good, huh? Buffett refused. He said, heck with that, I don't need that. I can bet you. I'll tell you what happened there. I can bet you Warren Buffett refused because he is not overestimating his ability to win, and because even $1 bet to win $10,000 is not worth it if the odds are 1 in 100,000. To break even on a bet where you bet $1 and you get $10,000, you need odds of 1 in 10,000, right? Warren Buffett probably said, I don't think I can win even 1 out of 10,000 times. Therefore, he refused the bet because basic statistics says that that would be negative expected value. It is not high probabilistic because he's not going to win. So there's no point of him betting $1 to win 10,000. In this case, it would be an even money bet. It would be worth it if he could put 10 cents instead of $1, because 10 cents would be 1 out of 100,000 odds. And Bill Gates gave him 1 out of 10,000 odds. And Warren Buffett said, no, I'm not paying $1 because the odds of me winning are probably less than 1 in 10,000. So it's at negative expected value. You tell me, does this stuff start to make sense to you? So don't fall for the false safety of limited risk. Options or even option traders that post stupid videos claiming that they have a high win rate, right? I've seen that on the internet. I see that coming up a lot now. I see option traders or not option traders, YouTubers, influencers that will say that they're option traders, the newer ones especially. They'll say, oh, we got a high win rate. Guys, look, I got a 90% win rate. Look at that. Guys, 90% win rate is no good to me. I don't care about what win rate is. Are you profitable? How much money are we making? 90%, if you have a high win rate and you win 90% of the time, you win $1 90 times, but 10 times you lose 50, do the math. You won 90 and you lost 50 10 times. You lost $500, you made 90. You're negative $410. You guys understand me? Win rate is extremely deceiving, okay? When I see other YouTubers claiming that they have high win rate, I laugh. I know that they don't know what they're talking about. I know they're marketing only. I know they don't know what they're talking about because having a high win rate is extremely not important and it's extremely deceiving. I'm not looking at win rate, guys, because again, going back to expected value, you can have a 99% win rate. If it's only $1 and your 1% lose rate loses $1 million, guys, that's no good. That is no good. So it's actually not win rate. It's all about expected value, which is statistics, and nobody's going to talk about it. Nobody's talking about how to actually make a lot of money. So, all right, so I'm just pulling up my portfolio here on my phone because I want to point out that in the past 1 month, I have had a 3.21% return and $112,000, okay? You can see that I'm not making crazy money by no means. I'm making 3 to 5% per month, but it is extremely, extremely consistent. And I pull up my videos all the time. I have nothing to hide. I've shown you guys over and over for the past 5 years, my whole entire journey to building this $3.6 million portfolio because I'm actually confident that I know what I'm talking about. I actually show my entire journey. And this $112,000 that I've made in the past month and 3% return, I mean, it's more than enough to live on. And also you can see that I'm going for high probability trades. Like you will see right now that I have Chipotle, Nvidia, Google, Nvidia, Target, Palantir. I got an SPY trade. By the way, this is a shorter term SPY trade. I opened this up a little bit short term here. I am doing some shorter term trading. It's actually yesterday I opened this up. I think today is, let's see what today is. So it's been like a day or so or two. So I actually opened this up the other day. And so far I'm already up on this position, $540. So yeah, SPY, you can make plenty of money in SPY, but there's so many positions that I have here and I'm I'm just trying to make consistent income, guys. I'm trying to place high probability trades. I don't care about a high win rate. I don't care about looking good. I only care about what are my actual results. How much cash am I actually making per month? What is the percentage return? Because obviously I have students that have smaller portfolios and we want to, grow their accounts. So percentage return matters. I get it. Not everyone has millions of dollars. You don't need millions of dollars. Average student account size is 70 to 100K. Obviously I have many 6-figure portfolios and then I have many 5-figure portfolios. So it's both. And one thing I want to point out is in my portfolio, I'm using boring companies. All right, I'm using very, very boring companies. So when it comes to psychology, a lot of people think that they have to get cute, they have to get really innovative. No, you don't. Literally, the stock market's a proven game that's been working for so many decades. Before my dad was born, I think around my grandpa was born, the stock market was around, right? It's been around. It dates back a long time, right? Early 1900s. I don't have the data in front of me. But this is a proven game, and options specifically are super lucrative because a lot of people are jumping into options right now. They don't watch my videos. They're not subscribed to the channel. They don't understand how I'm trading, and they're following like rumors, right? That's why Warren Buffett doesn't live in New York City, is because there's just too many rumors and people have bad results. It's like so funny. New York City, which is the capital of finance, has some of the worst results because there's so many people that are over trading and they're overdoing it in New York City. They are trying to outperform the market and they get other opinions and they end up underperforming the market completely. That is our lengthy chapter. Let's go to the next chapter. The next secret and lie in the industry is high volatility plays equals more money. False. You guys saw my portfolio. My portfolio of boring companies has outperformed all of the interesting investors on YouTube, in the stock market, online, and basically everyone who is going for sexy has underperformed me. I've performed better than, I've seen guys on YouTube, Tattooed Chef, and all these little stocks, and this will make you a millionaire. No, I haven't seen any millionaires that have made $1 million and kept the $1 million. Some people made $1 million, none of them kept it, all right? And that's because boring wins, guys. Boring and simple wins. That's why my YouTube channel here, I almost want to change my name. I almost want to do wheeling strategy with Henry, all right? Run the wheel with Henry. This strategy I've been using for a decade. Since I was like 19. I was a teenager. I've been running the wheel. I literally became rich. Part of it, I'll be honest, was bull call spreads on Tesla. So let me not say I made all my money on the wheel, because that would be a false statement. I'd be lying. I didn't make all my money on the wheel, but I've certainly built my most consistent income from the wheel. All right, I've made like $500,000 to $600,000 on spreads, and it helped me grow my portfolio for sure. But I took a little bit higher risk, and I would have still gotten to where I am today, just a little bit slower, had I just ran the wheel strategy. And I'm running the wheel predominantly right now. I'm not doing spreads as much anymore, but I was. So let me be honest. Let me be honest about that. Anyways, the allure of high volatility options, guys, is not actually all it's said to be. The allure of high volatility options often draws traders in with the promise of substantial returns. Many believe that riding the wave of volatility will lead them to quick profits. I'm lured by stories of traders who hit it big overnight, right? Like, oh, they hit it big. Oh, let me go for high volatility. No. This excitement often overshadows the real risks involved, as traders tend to underestimate both the inherent volatility and the effect of time decay on their options. Okay, time decay, very, very important. We'll cover that soon. So when I sell options, I use implied volatility, but it's not really the main focus. All my profitable students and I have over basically thousands of all my profitable students and I over basically thousands at this point, by the way, with the students. It's been like all my profitable students, and it's been thousands at this point. I've coached thousands of students that have watched me become profitable. I have 20 one-on-one students at the moment, which is, by the way, what I'm focused on. I'm focused on one-on-one coaching more so now. I still have Discord, but I'm focused on one-on-one coaching, which includes Discord, all right? At this point, we're only focusing on delta and theta. We're focusing a little bit on volatility, but I'm paying really close attention to just delta, because delta gives you a lot. Delta tells you the whole picture very, very quickly without having to waste a lot of time. And I create a 15 stock watch list with them. And when I do my one-on-one coaching, I'm like, listen, we just need 15 stocks. We need to do this on a consistent basis, doc. A lot of doctors I work with, so I say, hey, doc, we're going to do 15 stocks. You do some covered calls. For you, doc, we're not even going to go 1 month. We're going to go 2 or 3 months. We're going to set the position. And if you feel worried, contact me. Otherwise, your prescription is you're going to wait until expiration with me. All right, we're going to wait until expiration. And as we get close to expiration, we'll have another call. We'll take a look at your portfolio, make some adjustments, maybe some rolls. But this time, Doc, go be a doctor, go enjoy life, go do your thing, because we're not actively trading. You don't need to. When you have proper entry, you don't need to do all that, right? If you're running the wheel strategy, and that's basically exclusively what I do with all my guys, it's very low maintenance. Low maintenance and low volatility can be high returns. So don't fall for the trap of hyped stocks and chasing volatility. That is a huge mistake on your guy's end. Huge mistake to follow just volatility blindly and just chase. Listen, you're not a lion. You're not chasing a gazelle all day, right? I mean, that sounds fun, right? But let's be honest. Let's not chase. Let's attract. Let's get that income to come to us. It's also a big psychological thing, right? A lot of people, you guys are chasing things in life. You tell me, has chasing, I have women watching, I respect women. I have a lot of women students. I recently had 2 women sign up. They're doing fantastic. They gave me a testimonial within their first month. But let me just say this for the guys. Chasing women, you don't get results. Chasing money, you don't get results. Chasing anything in life, you don't get that outcome. When you relax, you lean back, and you don't need it. I don't need money. I don't need women. I don't need nothing. I'm fine. I'm chilling myself. I'm fine. Guess what? Right now, I'm getting all the results. I'm getting the best students. I'm getting the best results when it comes to trading. I'm getting high-level women, getting good women. I'm getting results at the gym. I'm getting results because I've stopped chasing. I need you guys to get into this mindset of stop chasing, start attracting, start getting your mentality and your mindset and your psychology to where you want to be. Pretend you're already there, okay? And then do as if you're already that successful person. Get rid of those bad habits and already function like you've already made it. That way, when you lose a trade, you say, listen, I'm a successful man or woman. It's all right. It's all right. I'm going to make it back, right? You got to be optimistic. You got to have that strong mindset, okay? Stop chasing. If you think you're making good money now in this market, you could be making a lot more. Let me tell you that also, all right? A lot of people, going back to the last 2 chapters ago about overconfidence. You think you're making good money? You can make more money, a lot more money. I have new students that make 17% return in their first month, okay? So if you think your 5K on 100K is good, it's good. But I have students making $17,000 on 100K. So be hungry, but don't chase. I have a video, by the way, on my momentum wheel strategy, which I think is really important because it's a little bit of a deviation on the wheel strategy. So I'm going to have that at the end of this video. When you get to the end, I tell you, you can watch the momentum wheel strategy. That'll be up on the screen. That's really important for you because that is the mixture of high returns. It's the mixture of low volatility. And that's actually what I've been implementing right now is the momentum wheel strategy. It's a strategy that I personally made up, and I'm innovating in this industry of option trading. I'm innovating because I'm the #1 option coach in the world. I'm innovating, and I think the momentum wheel strategy is specifically using higher momentum stocks in a certain pattern and trend to use the wheel. So I'll add that at the end, or it'll be in the description. You can watch later. Whew. All right, guys. We got through another chapter, all right, in this course of just really outsmarting the market and putting psychology to use to make a lot more money, to dial up your gains like crazy. In this next chapter, all right, we're going to talk about confirmation bias and strategy selection. This is the big pitfall even the expert traders make. This in general is, by the way, a very huge human error, very huge bias, all right? Confirmation bias is a cognitive bias that causes individuals to favor information that confirms their existing beliefs or hypothesis while disregarding or downplaying evidence that contradicts those other beliefs, all right? In the context of trading, this bias can lead traders to seek out data, analysis, or narratives that align with their current strategies or their viewpoints. For example, all right, if a trader believes that a particular stock is, destined to rise, you're in love with Palantir. I like Palantir too, but I'm not in love with it. I'm not married to it. Palantir has a bad quarter. I see something bad. I'm out. I don't get emotional about money, guys. I'm trying to make money here. I'm trying to make you rich. I'm not getting emotional. If a stock has bad earnings, I'm not married to it. I'm out. I'm out. The door's right there, all right? Investors, they may actively look for positive news or analyst reports that support their views while ignoring bearish indicators or warnings. This is super dangerous, right? Very, very dangerous, right? It's kind of like the equivalent of a woman who falls in love with a man. The man's a bad boy, tattoos, thief, robber, whatever. And that woman's like, oh, he's my dream man. He's okay. Like, dude, that guy's in the streets like killing others and she's with him. All right. That's super dangerous because that woman is in love. That's like a romantic example, right? I'm giving you guys examples across the board. Sorry if some of my examples, not the most appropriate or whatever, but I'm just giving you examples of how psychology works, which is what this course is about, okay? It's super dangerous to fall in love. It's super dangerous to be completely dependent. It's super dangerous to have confirmation bias, all right? Confirmation bias. I took a lot of psychology, as you guys can see. I'm very well-rounded. I'm pretty good in many areas of the important areas of life. I'm always studying, always improving, because when you improve, you do a better job. You do a better job as a human. You do a better job with God. You do a better job in your results in all areas of life. So I just want to say that one more time. Now look, this confirmation bias is very common in politics. It's common in romantic relationships. It's common in sports and many other things in life. Trading is life. Trading is life, guys. It's literally life. All right. So a diehard fan of a sports team, for example, may highlight their team's strengths, right? I don't know. I'm from Philadelphia, right? So I don't watch football. I watch tennis. But let's say you're an Eagles fan, right? Or Cowboys or whatever, right? I don't watch football. But let's say you're a diehard fan of the Eagles, right? You may highlight, hey, Donovan McNabb or whoever is our quarterback at this time. Been a while. He's the best. We have all these strong players. But you're going to ignore the weak players, right? Let's go to tennis, for example. You might say, well, Roger Federer doesn't really have any weaknesses. I'm trying to point out a weakness, but the top players don't have any weaknesses. Alcaraz right now has no weaknesses. Federer has no weaknesses. Djokovic, Nadal, they don't have weaknesses. But you kind of see where I'm going at. Especially when there's a team sport, basketball, football, there's typically a player that is a little bit lower than other players. Even though they're all A players, there's typically like an S player who's like better than the rest, like LeBron James, whatever. People who love their teams will downplay the bad part, right? Oh, no, that's nothing bad, right? He's all right, he's good, right? So that's confirmation bias. You're gonna actively look for reasons to believe. You're gonna passively look for reasons not to believe, all right? So in the case of the woman in love with the killer bad boy, she said, oh, well, he hugged me today. He's a nice guy. But he killed someone. Oh, well, he was just having a bad day. See, it's a little extreme. But confirmation bias is extreme, guys. I'm not being extreme. I'm telling you what I see every single day. I see traders, they have a stock, they fall in love with it, they're immune to the bad news. Bad news comes out, no, the company's good. While the company's falling, it's a negative momentum spiral. No, it's okay. Crashes 30%, and then they change their mind. Too late. It's too late. You got to look at the writing on the wall. Once you see a warning, got to start thinking. Don't get tied to the stock. Think for yourself and don't have confirmation bias. All right, let me go for more example. For instance, a fan of a football team might celebrate a recent win as evidence of their superiority of that team, right? But he may neglect to consider their poor performance in the previous matches, right? Or attribute those losses just to bad luck. Guys, I don't really believe in luck. I believe in skill and statistics and data, all right? In God we trust. All others must bring data. That is my statistics professor's mug on his desk. Sports betting, by the way, if you're curious, is also a lot confirmation bias, all right? It can be very profitable, by the way. Sports betting can be very profitable. I'm curious if you guys do that, but curious if you guys are into sports betting. I personally am not against it, right? I think it could be profitable. So look, my goal is not only to make you richer, but to protect you from getting poorer. And one secret to making money will sound funny. One secret to making money is not losing money, all right? Confirmation bias makes you lose money when you have many win streaks on one strategy or one stock. Fall in love with it, you become blind, your position sizing increases, becomes huge, you become overconfident, which is what I covered in the other chapter. You guys reading the news only on the positives, positive, watching content that confirms your confirmation bias, that persuades you to be even stronger on your confirmation bias, very dangerous. Not even aware of it. Goodness, I'm actually making this course. I think it's a little, I don't even know if I'm going to release it. It's a little bit too powerful, guys. These topics no one's ever covered on YouTube. These are topics that I've gotten from the CIA, from Goldman Sachs. These are inside topics that are very powerful. I'm almost a little scared to even share this video. It's a little too powerful on psychology of the market. You guys are going to be a little too strong. You guys are going to be bicep over tricep. You're going to get so big and so rich. Be careful. I got to have a little bit of fun on these videos. All right, let's get back to serious mode because we're here to make money, aren't we? This is why I always teach risk management in my Discord, guys. And regardless how much money I make, I still stay humble and I don't increase position size beyond 15% per position. I don't care if you have the golden goose. You got the golden goose position. You got the Hail Mary. You got the LeBron James of stocks. We don't fall in love here, guys. We don't fall in love with one stock and hold it for life. All right? We don't do that here. We're rational. We're trying to get rich fairly fast and very safe. We're trying to get rich, fast, safe. Those three things don't necessarily go well together. That's why we're optimizing, and that's why I'm here as a coach to help you optimize for that outcome. I have a coach myself, guys. I have multiple coaches, by the way. I love coaches because the cheat code in life is having a mentor, someone that's above you, teach you 10 years of information in 1 month. That's why I'm so far along. I have mentors. So look, when it comes to stocks, I am massively bullish on. I do not blindly buy too much of them. Very important statement. Even stocks I am massively bullish in, I do not blindly throw too much money in. I keep my position sizing safe. Make sure that you have position size correctly. Make sure that you're reading all news on a stock, good and bad, and make sure that you don't fall for confirmation bias. Let's get into the next chapter. So this chapter will be the psychological trading secret that you must be aware of, which is the gambler's fallacy in option trading, all right? I want to address how traders often think that they are due, all right? Often traders say, I'm due for a win after strong losses. They have a lot of losses. I'm due for a win, Henry. I'm due for a win. This leads to very poor decision making. Or the opposite. Listen, a lot of people, I'm winning. I don't need help, I'm winning. I'm confident, I'm winning. I'm a man, I'm winning. I know what I'm doing. Winning. Big loss. Boom. It can happen to anyone, all right? Win. You can still lose. Lose. You can still win, all right? You need to stay balanced. This is important. Professional poker players, by the way, have coaches, and they talk about something, it's been a while, but they talk about balanced strategy, balanced risk management. Poker is about risk and management. Sports is about risk and management. Relationships are about risk and management. Your trading is about, yeah, you guessed it, risk and management. Let me paint you a picture right here using statistics and numbers. If you flip a quarter 5 times and it's heads 5 times, this doesn't change the odds of you flipping the 6th time. Does that make sense? All right. If I flip a quarter right now, all right, I don't think I have a quarter in my office, all right? But if I take a quarter, right, and I flip it once, I flip it twice, all right? It's heads. I flip it a 3rd time. It's heads, all right? We see that tricep. 4th time, heads. 5th time, heads. What would you say? Henry, it's going to be a 6th quarter, huh? It's going to be a 6th quarter. What are the odds of that 6th flip? What are the odds? Let me tell you the odds. They're still 50-50. The odds are still 50-50. I'm excited. I got to entertain myself during these videos, especially when they're long. All right? I'm going out of my way to give you everything I got because I want you to level up. I want you to subscribe. We're about to hit 300,000 subscribers. And my community is growing like crazy. I'm having so much success. I'm so freaking blessed. God bless me so much to help you guys. I feel happy, blessed. I feel blessed being able to bless you guys with money. And then I feel like I get more blessings blessing you. It's like a forever giving. I love it. So look, 50-50 is the odds of a quarter. So it doesn't matter if it hit 5 times. So you guys that think you're due for a win or due for a loss, get that out of your head. If you have the proper strategy, you're due for a win, more likely than not. If you have the right strategy, you're due for a win always. And if you have a bad strategy, you're due for a loss always, all right? So that's basically how it works. So this is a common but very dangerous mental trap. It's extremely dangerous because our brains are made to detect patterns. So if you see heads 5 times in a row, your brain will trick you and tell you, wow, it's gonna be heads again. But that's not true, it's just 50-50. So where traders misunderstand probabilities and overestimate, aka overconfident, but overestimate their chances of winning on the next trade, okay? This is particularly interesting because in the short term, it is important to understand a stock having multiple days of a win streak, just like the quarter, it doesn't make it so that the next day is gonna be a win. It's not so, guys, it's not so, all right? So multiple days doesn't mean a damn thing. It means nothing. But multiple months does mean something, okay? So there's a little bit of a nuance here. Multiple days don't really do anything, right? But multiple months do. Multiple months is momentum. Multiple days is just luck. All right, so I want to educate you on how to recognize this fallacy and promote disciplined trading strategies. Short term, nobody knows, guys. It's gambling. Nobody knows. Don't chase. And rule number 3, don't freaking chase, all right? Short term, nobody knows. Long term, it's obvious. And why my portfolio is about to hit $4 million. Guys, it's obvious. I've shown you the whole journey, it's obvious. I know what I'm doing better than anyone else does. I've mastered this game. Long-term is where it's at. Having a long-term mindset, a long-term strategy, long-term beliefs, not falling for the fallacies, the misinformation, and myths that I've covered in this video will help you also master the game and scale your portfolio to 7 figures. I'm helping you guys here along the way. If you're subscribed, I'm gonna keep making the best videos on YouTube, hands down, the best videos on YouTube to level your trading, to give you as much free value, better than people's paid value, giving you more free value. So if you want any coaching, you can feel free to, use the first link in the description. Otherwise, I am super thankful that you guys have made it through the end of this video. That means that have a really good attention span, which actually is also a psychological thing, which is gonna make you a better trader. So congratulations on that. Thank you for watching, and make sure that you watch this video on the momentum wheel strategy.